Monthly dividend ETFs can be an extremely powerful tool for you to make additional income every month, but if you do not understand them properly, they can become a serious issue. For instance, you may think it's all about the dividend yield, but that's actually not the most important factor. The impact of high growth along with your dividends is what you'll really need. If you don't believe me because I'm just a random guy on the internet, let's go over a real-world stat sheet with the Global X Super Dividend ETF that has an 11.29% dividend yield. Sounds unbelievable. Let's just buy it. Well, don't think too soon, because even if you reinvest that 11.3% dividend yield over the past 10 years, you would have actually lost money at an average annual rate of 3.28% per year. But not even that, if you instead took the dividend yield of 11.3%, that means that without reinvesting back into the fund, your investment would have declined on average 10.83% per year. So when this is all computed, that means that $1 million would have turned into $300,000 in just 10 years. It's really important to understand this because by the 10th year, you're going to be making so much less in dividends than when you started. So before I dive deep into the best ones, just understand it's not all about the dividend yield. You also want to see growth within the fund and allow the power of compound interest to take place. Which, if you don't understand the power of compound interest, a famous analogy is a snowball rolling down a hill getting bigger and bigger, but instead it's your cash. When you're investing it over the long term, it's going to continue making more and more money over time. Now, although two of the four options I'm going to show you in this video are newer options, meaning they don't have many years of historical data, they have all averaged so far of their lifetime over an 11% annual return. Which, believe it or not, at the end of this video, I'm going to show you a portfolio using all four ETFs that recorded a compound annual growth rate of 17.65% for the entire year of 2023. With that said, let's get straight into it, with the first one being the JP Morgan Nasdaq Equity Premium Income ETF, ticker symbol JEPQ. Now, this ETF provides exposure to growth by investing in US large cap growth stocks through the Nasdaq 100 index and generates additional income through a combination of selling options and receiving stock dividends. The fund currently has 98 holdings, with the top ones being ones you've definitely heard of, like Microsoft, Apple, and Nvidia. The fund comes at an expense ratio of 0.35%, which means for every $10,000 you invest in this fund, you'll be paying $35 per year in fees. Now, when it comes to the expense ratio, anything around the 0.5% or lower is going to be pretty good because everything's pretty much automatically managed for you, and all you have to do is click two buttons. Now, JEPQ is currently sitting at $53.28 per share with a dividend yield of 10% as of April 30th, 2024. By multiplying the dividend yield, the 10%, to the share price, this means that for every share you own, you would be estimated to get just over $5 in dividends after a full year. Which, to put that into a monthly payment amount, all you have to do is divide that by 12, so that's going to be just over 40 cents per month. Doesn't sound like much, but let's say that you bought 100 shares, that's just over $5,000 worth of stock, and with that, you could get $40 per month from dividends alone. The only downside with this fund is that it's only been on the market for 2 years. Although the fundamentals are strong, it's still not enough time to get a true comparison. But so far in 2 years, JEPQ has seen an average annual return of 13.69%, which includes all factors such as expense ratio and dividends being reinvested into the fund. So even if you want the monthly income and you're not going to reinvest the dividends, this fund has proven to have somewhat of a moderate growth potential, but of course, past performance doesn't guarantee future results. Moving on from there, another fund that could go well with this fund would be the companion JP Morgan Equity Premium Income ETF, ticker JEPI. Now, JEPI provides exposure to growth by investing in US large cap growth stocks through the S&P 500 index and generates additional income through a combination of selling options and receiving stock dividends. This fund, instead of having close to 500 companies like the S&P 500, only has 135 holdings that cover 15.5% of the fund, with the top ones being Trane Technologies, Progressive, and Amazon. The fund comes at an expense ratio of 0.35%, which for every $10,000 you invest is $35 per year in fees. Now, this fund is currently sitting at $56.74 per share with a dividend yield of roughly 7.5% as of April 30th, 2024. This means that for every share you own, you are going to be getting roughly $4 in dividends after a full year, which, to put that into a monthly payment, is roughly 35 cents per month. Let's say you buy 100 shares, that's just over $5,000 worth of stock. That could earn you $35 per month from dividends alone. The only downside with this fund is that it's also somewhat new to the market because it only has 4 years under its belt. Now these two funds are obviously aimed for a high dividend yield, but they have proven to have somewhat moderate growth as well. But the next one I'm going to show you has a much lower dividend yield, which it's going to be pretty hard to beat those ones, but it's seen a very strong growth rate over time, and that is the WisdomTree US Quality Dividend Growth Fund ETF, ticker DGRW. Now DGRW seeks to track the investment results of dividend-paying large-cap companies with growth characteristics in the US. The fund has 299 holdings, with the top 10 holdings covering 36.5% of the entire fund, starting with Microsoft, Apple, and Broadcom. The fund comes at an expense ratio of 0.28%, which for every $10,000 you invest is $28 a year in fees. Now DGRW has a dividend yield of 1.67% and has been around the longest of the options I'm showing in this video, with the past 10 years having an average annual return of 12.29%. The only downside I see with this is if you are looking for solely high dividend yield opportunities. But the purpose of this video was obviously to get the 4 best monthly dividend ETFs, and I believe if you put them all into one portfolio, over time it could do extremely well, and as it did for 2023, it achieved that 17.65% annual return that I mentioned at the beginning of the video. So in regards to this fund, I truthfully believe that if you have one with solid dividends but is aimed with higher growth potential to appreciate in value, that it is a great addition to the overall portfolio. So overall with dividends, you're trying to find a high yield but also high growth, and you're trying to balance that out because like I said, if you go only for the high dividend yield, your portfolio could actually be declining in value. So with that said, let's go into the last monthly dividend ETF, that is Amplify Enhanced Dividend Income ETF, ticker DEVO, of high quality large cap companies with a history of dividend growth along with a tactical covered call strategy on individual stocks. The fund has 42 holdings, with the top 10 holdings covering 53.5% of the entire fund, starting with Invesco Short-Term Investments Trust Government and Agency Portfolio, which has 8.17%, where this fund mainly holds cash, government securities, and repurchase agreements. Other investments also in the fund include United Health Group, Microsoft, and Procter & Gamble. And I know you're seeing a lot of large cap stocks within these ETFs, but don't worry because the overlapping is minimal. In fact, I checked them all and the most overlap between two funds is 31% between JEPQ and DGRW, which isn't bad at all. Another one you may be interested to see is DEVO and DGRW that have a 30% overlap by weight. None of these are terribly high compared to something like the S&P 500 and the total stock market that have a 86% overlap by weight. That pretty much means that if you own those two funds, they are very similar to the investments that are inside of the fund. If you want to play around with this, I'll leave a link in the description below for you, as well as other relevant content I think you'll benefit from. Alright, so back to Amplify's Dividend Income ETF, DEVO. This fund comes at an expense ratio of 0.56%, which for every $10,000 you invest is $56 a year in fees. Now this is pretty high, especially compared to basic index funds that I've mentioned on my channel, but it's not terrible for being actively managed for what you can get. And don't forget that all the annual rates with these funds include that expense ratio already. Now DEVO has a dividend yield around 4.5%, and over the past 8 years, which is since its inception when it was officially created, it has averaged an annual return of 11.44%. And because the annual return includes the expense ratio, I don't really see any downside to owning this fund. Besides the fact that there's only 42 holdings, one could say that's a very low amount, but with all 4 ETFs, there's already so much exposure, I don't see that being a concern. So speaking of, let's go over the ultimate portfolio using these 4 monthly dividend ETFs. Now this portfolio is going to be split equally for each fund, so that is 25% JEPQ, JEPI, DGRW, and DEVO. Ideally, I would love to see at least 10 years of historical data for each fund, and because that's not the case, I'm going to show you exactly how long each of them have been on the market. So for starters, JEPQ has been on the market for 2 full years, JEPI is 4, DGRW is 11, and DEVO is 8. To me, having 8 and 11 years is good enough, and because I understand the fundamentals behind the JP Morgan funds, I do believe that going forward, it's still going to earn solid rates over time while still offering that dividend yield for those interested. In fact, JP Morgan notes that a 60-40 combination of JEPI and JEPQ can get you close to the S&P 500 exposure while still earning income beyond normal measures. Keep in mind that JEPQ over the last year returned 25.5%, which is lower than the NASDAQ 100 index at almost 33%. And then for JEPI, over the past 3 years, it returned 7.2% annually when compared to the S&P 500 that was 8.06%. 0.06. All in all, when looking at a portfolio that combines all 4 of these monthly dividend ETFs, it turns out that if you reinvested the dividends, it would have achieved a 7.65% compound annual growth rate for the year of 2023 alone, and that's after all expenses. Let's say you didn't reinvest the dividends, you would have still earned a 10.41% CAGR. So for those ambitious to live off of dividends, if you had $1 million, your portfolio after 1 year would have generated you $66,000, which is a 6.6% dividend yield. On the other end, if you reinvested the dividends, your portfolio would have grown to now be $1.17 million, which means for that year alone, your portfolio grew $176,000. Now, something you need to understand is the tax treatment with these funds can vary based on the holdings. Because majority of these are viewed as inefficient for tax purposes, having these in a non-taxable account like a Roth IRA could do you really well. In fact, for those curious, here's a picture of recommended locations to place specific assets based on the tax structure. As you can see, simple stock index funds or tax-exempt bonds would be best suited for a typical taxable account, where balanced funds would go best with Roth IRAs and those that provide tax advantages. If you are one looking to gain dividends solely through taxable accounts, I highly recommend researching and making sure that they can be qualified dividends. This generally means you must own the stock for more than 60 days during a specific period, and the dividends must be paid by U.S. or qualified foreign companies. If that criteria is met, your dividends are going to be taxed at the capital gains rate, which is much lower than ordinary income. Now, if you want to see the spreadsheet that shows each of these investments and a few other dividend ETFs, I'll have a link in the description below for you. And while you're at it, don't forget to check out my free learning guides about investing, savings accounts, or other financial topics. And don't forget to check out my newsletter, where I write every week on topics that can help improve one's financial knowledge. If you're interested in learning about dividend investing, I'll be making an entire video on that soon, so stay tuned to the channel. And as always, don't forget to hit the like, subscribe, and notifications button to be alert for future content like this.